Your landlord checks it. Your car dealer checks it. Your bank checks it before they give you anything. And if that number is low, you are paying more for basically everything. Sometimes tens of thousands of dollars more over your lifetime. I'm talking about your credit score. And the wild part? Most people your age have no idea how it actually works. By the end of this video, you'll know exactly what moves your score up or down, which rules you've been told are completely wrong, and what you can actually do this week to start building it. Even if you've never had a credit card in your life, your credit score is a 3-digit number between 300 and 850. It tells lenders how likely you are to pay back money you borrow. Higher number, better risk, better terms. That's it. Here's the general breakdown. 300 to 579 is poor. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good. And 800 and above is exceptional. Most people in their early 20s land somewhere in the 600s, which sounds fine. But it's quietly costing you money. Here's a real example. The difference between a 620 and a 760 credit score on a $300,000 mortgage can be over $100 a month in higher interest. That's $1,200 a year. $36,000 over 30 years. Just because of a number you didn't know mattered. Your credit score is not just a grade, it's money. There are 5 things that make up your credit score, and knowing them changes how you make decisions. Payment history is the biggest one at 35% of your score. Do you pay your bills on time? That's it. Every on-time payment nudges your score up. One missed payment can drop it by 50 to 100 points and stay on your report for 7 years. Set up auto pay. This one is non-negotiable. Credit utilization is 30%. This is how much of your available credit you're actually using. The rule: stay under 30%. If your card limit is $1,000, don't carry more than $300. Ideally, keep it under 10%. High utilization looks like financial stress to lenders, even if you pay it off every month. Length of credit history is 15%. The longer your accounts have been open, the better. This is exactly why people say start early. And it's also why you should never close an old credit card unless there's an annual fee you can't justify. Closing it deletes that history. New credit is 10%. Every time you apply for a credit card or loan, lenders do what's called a hard inquiry. It temporarily dips your score. Applying for 4 cards in 2 months looks desperate. Space out applications. Credit mix is the last 10%. Having different types of credit, like a credit card and a student loan, shows you can handle multiple obligations. Don't go out and get a car loan just for this, but understand why it matters. Here's one of the biggest credit myths out there. Checking your credit score hurts it. That is false. When you check your own score, it's called a soft inquiry. It does not affect your score at all. 0. The only time a credit check hurts you is when a lender pulls it to approve you for something. That's a hard inquiry. So there is literally no reason not to know your number. Go check it today. Credit Karma is free. Experian is free. Your bank's app probably has it built in. Soft inquiry doesn't hurt. Go look. Now let's clear up a few more things people get wrong constantly. Myth 1. You need to carry a balance to build credit. This is completely false, and it is costing people money. Carrying a balance means paying interest, which is throwing cash away. Pay your card off in full every month. Your score builds from using the card and paying on time, not from carrying debt. Myth 2. Closing a credit card improves your score. Usually the opposite happens. Closing a card reduces your total available credit, which spikes your utilization ratio. And if it was an older account, you're also shortening your credit history. Both of those hurt your score. Myth 3. You need to make a lot of money to have good credit. Your income doesn't appear anywhere on your credit report. A person making $30,000 a year can have a higher credit score than someone making $200,000. It's entirely about behavior. Paying on time, keeping utilization low, not opening a bunch of accounts at once. If you're starting from zero, here's the move. Get a secured credit card. You put down a deposit, usually $200 to $500, and that becomes your credit limit. Use it for small, predictable purchases like gas or streaming subscriptions. Pay it off in full every single month. In 6 to 12 months, you'll have a real score. If you already have credit, run this checklist right now. First, check your score. Free, no excuses. Second, set up autopay on every account so you never miss a payment again. Third, log in and look at your utilization on each card. If any of them are over 30%, either pay it down or call your card issuer and ask for a credit limit increase. That last one is underused. Asking for a credit limit increase can instantly drop your utilization percentage without you spending less. Your balance stays the same. Your available credit just went up. Just don't treat it as permission to spend more. Your credit score is one of those things that quietly follows you everywhere. Every apartment you apply for, every car you finance, every mortgage you eventually want. The people who understand it early move through life with less friction and less interest. And now you know more than most people twice your age. Next week, we're getting into emergency funds, how much you actually need, where to keep it, and why the advice you've probably heard is wrong. Subscribe so you don't miss it.